I'm just gonna wait for just a few seconds to make sure I'm doing this right. It's been a few minutes since I've streamed, so okay, yeah, it looks like it's starting up. So alright, so I'm basically making this video to talk about options because they're my newfound love. So I figured that for the group that I've made since I started with trading stocks and then eventually moved on to options, I took a bit of a break from Facebook in general, and I still am taking a break. I just came back, I guess, just to become active on the group, more or less. But I'm still not like active on Facebook at all. I just get nothing, no notifications or anything turned on because big distraction and just a lot of toxic environment that tends to change my mood for the day. So I said forget it. But let's go. Here we go. Alright, so I kind of made like a little bit of notes on how I wanted to make this video. First, I wanted to talk about like what are options and your understanding of options. And the easiest way I'm going to explain it is going to be in very layman terms. And then what I'll do is I'll take it from layman terms and I'll try to make it, I'll explain it in the actual terms. So hopefully it'll click at that point. But I'll start with shares. What are shares? How are shares created? Who makes shares? How are shares distributed? These are things I hope you already know before you started trading. But just to talk about how shares are created. Hold on, Roger. Come on, buddy. Move. Thank you. So shares, they're created by companies. So if, in other words, when a company goes public, as you know, many companies, when they go public, they're known as IPOs, the initial public offering. They determine the amount of shares and the market cap, meaning the value of the shares, and the amount that are going to be available to purchase. Options work a little different. They are not created by the company. They are actually created by the shareholders. So if you decide to purchase shares of a company, you are actually a owner of that company. Whereas if you decide to purchase options, you don't own the company at all. You simply own the option to purchase. You actually own a contract, but we're going to get into that a little bit later. Like I said, I want to keep it simple so you guys understand. Hold on, I got a dog and he's just trying to get on my lap, and he's not a lap dog. Come on, buddy, get down. Thank you. Alright, so I want to keep it simple in the sense of understanding options. So what exactly is an option? I'm going to explain it how I understand it. So I mean, you can get on Google and you can determine the actual technical definition, which let's go ahead and just take a look. I should put, what is an options contract? An options contract is an agreement between a buyer and seller that gives the purchaser of the option the right to buy or sell a particular asset at a later date and agreed upon price. Options contracts are often used in securities, commodities, and real estate transactions. I mean, this is exactly what it is, but the way to understand it, I'm going to break it down. So I'm losing my train of thought here and how I was going to go forward about this. Because to me, it's all, I already understand it, so I'm just trying to make sure that I cover the very basics so I don't miss over anything that someone might get confused on. And let me just go back here. I don't know, where do I see a chat? Make sure this is muted. Okay, if I see something, I'll see in the chat here. Am I streaming? Interesting. I don't know if I'm even streaming. Oh yeah, I guess I am. Anyways, alright, so just continuing with the video. So an option is a contract. So how options work are basically that your easiest way to explain it, you know what, let me do it this way. So how options work is that they have a couple different factors. The strike price, which is the price that you think that the stock is going to be at a certain point in time in the future, and then the price of the option. I don't even know if that makes sense. So let me just put the all right. Okay. I'm just kind of drawing something quick here to hopefully make what I'm about to explain makes more sense if you see it visually. Okay, so let's go back to the actual definition of what an options contract is and use it in an example in real life. So it's an agreement between a buyer and seller of a option to buy the underlying security, which in this case is the stock, for a agreed upon price at a future date. So let's look at how a options contract chain looks. So this is what you're going to be seeing when you actually see options and chain. So what I'm going to do is I'm going to type in let's say Facebook Yahoo options chain. Okay, so this is how you're reading the option chain. Right now the price of Facebook is $195. With options, you are guessing what the price of the stock is going to be in the future. That is the easiest way that I can explain options to you. That you are simply guessing what the price of the stock is going to be in the future. How far in the future? That is what these options chains are. So if you look right here, these are all different option chains. They all mean, so how options work is this. Before we even get into these time frames, let me explain to you, because these are all different contracts right here. This one right here is options that are going to be expiring on June 22nd, 2018. What that means is when a contract expires, if you are holding it, meaning like buying and selling, and you bought it and then you hold it to expiration, it's worth nothing. Contracts are nothing. Contracts are simply what they sound like. They are a contract, a right to purchase the stock. What you do is, if you want to purchase the stock at the, what the contract price is, then you exercise the option. Most people hardly ever exercise the option. They simply buy and sell contracts just like you would shares. You want to buy the contract for low and sell it for high, just like you would shares, and vice versa if you're going the opposite direction. So I'm going to explain to you how to read these option chains. And I'm going to keep it simple now. I'll explain what the detailed information means further into the video, but for right now I want to keep it simple. So these are calls. Calls means that you think it's going to go up, meaning that the price of the stock is going to forward up in price, and vice versa would be puts. So in this case, we are looking at Facebook, which is currently $195.85. If you look right here, which is called the strike price, this is where we want to go down to. So right here is where Facebook's price is. So if you're looking at options and you think it's going to go up, you want to more than likely look at out of the money options. And what that means is, like, if you're purchasing right here $197.50, you're pretty much purchasing right below in the money. So 195 would be in the money because the rest of the stock is already over 195. As you can see, the more in the money you go, like if you want to purchase $180 call options, they're already $15. So, and I'll explain how to read all this in a moment, but for right now, understand the most important thing to look at when you're looking at options is the strike column, which is where you think the price of the option or the price of the stock is going to go. Remember, options are always based on the underlying stock security or a ETF. So in this case, we're going to use Facebook as an example. So 195.85, right? This is what Facebook is right now. So let's say today's June the 17th. I think let's say by the end of the year, I think that Facebook is definitely gonna, or not even end of the year. Let's just say that Facebook has earnings coming up. I'm just using a hypothetical here, so don't get upset when you realize that earnings are not coming up. I don't even have an idea when earnings are for Facebook next, but never. Let's say earnings are coming up, and then let's say they are, let's say they're Friday, and you think that there's going to be a run up to earnings, and that even earnings are going to be blasting through all expectations. You think guidance is going to be raised. So in that case, if earnings are the 22nd, you probably, you can, depending on how much you want to hold if you want to hold it through earnings, you definitely don't want the 22nd expiration, because that means on June 22nd, no matter what, the options are going to expire. So if you want to hold the options contracts through earnings, you probably want to go June 29th. Now here's the catch though: the further you go out, you notice you can go all the way to June 26th. The further you go out, the more of the options contracts get. And I'm going to explain to you how to read the pricing in a moment. So for right now, we are just going to go to June 29th. We're going to go to June 29th, which is not this week, but next week expiration. This means that all of these contracts, if on June 29th, if we're holding them, they're going to be absolutely worthless at the end of the business day. So price of the option is price of the stock is 195.85. Let's say we believe that there's going to be a 10% move through earnings. Wow, holy cow, this thing is, there we go. We think it's going to be a 10% jump through earnings. So we'd probably want to buy, somewhere in the 215 or 215.50s if they have them, options. What we're going to do is we're going to scroll down, right? And boom, right there, the 215s. How to read this is the Facebook June 29th, 2018, 215 call. You can read it this way. I wouldn't even start reading it this way. The easiest way to read it is this. You go first to the strike column. You believe that the price stock is going to be $215 because earnings is going to be sometime before then, and so you want to buy this because that's your personal belief that the projection is going to be that. How you determine the strike price is your trading strategy. I use technical analysis with I'd like to say a sprinkle of fundamentals. That'd be the best way to put it. But technical analysis with a sprinkle of fundamentals. But nevertheless, I usually let the charts dictate trade. And with options, you're going to learn very quickly how the return is significantly different because they're leveraged, and I'll explain all of that in a moment. So going back to our analysis, or this example rather, 195.85, we think there's going to be a 10% move after earnings, or up to earnings. We think there's going to be a ramp up to earnings, and for whatever reason we have came up with a target price of $215. So we want to buy the 215 call option. So how do you read this? This is the last price, bid in the ask, just like stocks. So last price was 17 cents, 10 cents, and 15. 17 cents is the mark, or the last price rather. So that means the last contract that sold, this exact contract, the last one that sold was 17 cents. However, it's not really 17 cents because one options contract represents 100 shares. So what you're doing is you're essentially multiplying this by 100, which is $17. So the last contract sold for $17, mind you. Now, right now the ask is 10 cents, which is $10. The bid is 15 cents, which is $15, meaning the seller wants $15 for the contract, the buyer wants $10 for the contract. They break it down to dividing it by 100 because the options contract is the equivalent of 100 shares. Every contract represents 100 shares of the underlying security. So if you're buying 5 contracts right here, buying 5 $215 6/29 expiration date. This is the expiration, the 6/29, because that's where we filtered it to up top, right here. So these are all June 29th, and we believe there's going to be a $215. The price in the stock is going to go up to $215 or close to it or towards it. Before this date of June 29th, or it'll surpass it. If it surpasses it, amazing. That's better. That's like the best news you can get. News that makes it so beyond 215, like let's say it goes to like a 30% jump. Then I mean that is, those are amazing gains. Kind of like my Dropbox gain that I just have, and still just a very little amount of contracts left. But I'll explain to you how all of this works in terms of pricing now. So now that you understand how to read these, remember what options are is you're simply guessing the price of the stock in the future. That's the easiest way I can explain it. Now, how options are traded, there's, I don't know, to me personally, there's countless strategies. I simply use what I found works for me. If you get out there, and I mean, don't get me wrong, I am learning every single day. I'm learning about all of the strategies between straddle, condors. I mean, you go through and you start getting in there, there's a ton of strategies, but I think a lot of those strategies work for heavier positions and long-term holds. So I tend not to be in those exact positions because the market, at least in my experience, especially my earlier days, is very volatile and hard to predict. So going back, so I'm just going to go through this options chain one more time. And this is, by the way, Yahoo Options. So I'm going to show you just another broker in my favorite, which is TD Ameritrade. And I'm going to show you how their options chain looks. So this is the June 29th, 215 option chain. So now what we're going to do is we're going to go to TD Ameritrade. This is, TD Ameritrade's a Thinkorswim platform. I'm going to click on trade, filter it to Facebook, and I am going to change and come down here to the June 29th. So see, these are the option chains. They go all the way down. And I mean, you can right click and go get into the settings and see beyond this if you wanted to, but most people don't because long-term options are very expensive. Like for example, let's just take a look. June 19th 2020 expiration, so you have a year and a half. Look at the cost of these. So it's $32.55. That's what it is for one contract, a single contract. But don't get me wrong, if it starts moving, you can, and going beyond that, you can make some serious money. But most people don't buy beyond, way out there, unless they're really cheap. And I actually did that recently, and it's starting to work in my favor. I bought Wells Fargo for a year and a half out for, I think it was 10 cents, $85, and then they repealed Frank Dodd. And give me 1 second, guys. I'm gonna answer this. One moment. And I'm back. Okay, and for those that don't know, I manage a hotel, so I feel like my job is never ending. So part of the reason why I like trading, because it gives me break from the madness that is what I call work. Okay, so going back to what we're talking about, this is, so we see what the options chain looks like on Yahoo, and I kind of told you how to understand it. The strike price is the price that you think that the option, I mean the stock is going to be at a given date in the future. That date is right here. So if you think that, you know, by, you know, because earnings coming up, so you think by next week or this Friday, so you want to buy, you know, by next week, because the further you go out, mind you, the more expensive the option gets. So let's just take a quick look for that example. So this $130, which is, you know, well above the money, because right now we're at what, 195, so we're well above the money. That's $66 right now. If we go out to July 6th, well, it's not even there, that call option. So let's look at, okay, so what was there? 150. So 38.28 is what the 150 here is. If I go 1 week out, 38.32. It's actually not that big of a difference on this one. Let's see if I go 2 weeks out, 38.90. If I go, look at that though, if I go a year out, it's almost 4 times that price. So, oh, actually no, that's $80. So it's 65, so it's almost double the price. So basically, in terms of option pricing, the further you go out, the more expensive it is. And you kind of want to play, and here's another key rule, is you don't really want to go way outside the money. What I mean by outside the money is whatever the current stock price is. So if we're at 195 something, you don't want to go, you know, way this way or way that way in either direction. If you're very bullish, you know, I mean, it's one thing to be bullish, but unless you know something that most people don't, which is probably more likely insider trading, you probably just want to stick to the 5 and 10% in and outside the money. That's what I feel. And I use my targets based on charts, which I'll explain later. So now, going back to all this, I explained all that. I'm going to show you basically how to read this on the Thinkorswim platform now. So here we go. Alright, so these are the options chains, different dates right here. I wanted to go to the June 22nd, and here it's only shown me 4 prices. These are the strike prices. Here it shows it in the middle. So this is 192, 195, 197. I want to see all. So this shows me all of them, right? So here's the 150, and then we said we wanted 10%, so this is the 215, right? So the 215, if I wanted to buy the call on TD Ameritrade, is 5 cents. So buy to open, yeah, or actually 6 cents if I wanted to buy at market. So that means it's you know, $6. So, which to me is, I don't know. To me, it's a no-brainer. If you think that's really going to happen, that's a cheap price for a contract, and if you really think it's going to get there during earnings. So let me show you. Let me go back and see if there's any questions. I keep forgetting to check that. No questions here. Nope. Okay. Alright. So I've explained to you guys what options are, or how to what in a basic concept what options are. Let me explain now how I told you how shares were as well. So in other words, a company decides how many shares are going to be out on the market when they decide to go public. When they decide to go public, they got to approach, you know, the Securities and Exchange Commission and present their business plan to go public. And if it's approved, then there's a roadmap to go public, and everybody gets a chance to get in on the IPO, etc., etc. Well, options don't work like that at all. So going back to my Microsoft Paint, this is where this is going to come into, this is going to make a bit more sense. So options work like this. Let's say I own 500 shares of Facebook. I myself, the individual stock owner, own 500 shares of Facebook. I'm the only person that can create options for that stock based on the underlying shares. So if I own 500 shares, I have the ability to create 5 option contracts. So what that means is this, that going over here on the trade grid in the options chain, let's say it's 195.85, right? I own 500 shares of Facebook. I want to create 5 call options because I think that Facebook will probably stay between $195 and $200 for at least the next month. That's what I believe. For whatever reason, I believe I own, a tons of Facebook shares. So, let's say I own 1,000. I want to take, I want to earn some money on the side. So what I'm going to do is I'm going to write 5 covered call options. And what I would do is I would write 5 covered call options for, let's say, $197.50. Right now, they're going for $1.43 a contract, or $1.42 is the last thing that they sold for. So if I own 500 shares of Facebook, I could write 5 contracts, and I would immediately get $142 per contract because that's what they're selling for. So, but I still own the shares. What typically happens is that the contract will get sold back and forth after you sell it, to the first buyer on the market. That contract will get bought and sold, and rarely does it get exercised. Exercised means that the person that owns the contract will then exercise the right to buy it. So let's say I sold that, I wrote that call option for $197.50, but let's say the price shot up, let's say Facebook and Google merged, right? And Google says, you know what, we're going to give, Facebook a huge influx of cash to, jumpstart their XYZ projects. And immediately with the influx of cash, it jumps the share price at $249. Well, guess what? If you've got call options for $197.50, you're going to want to exercise them. Yeah, you're probably making some money here on the price of the contract, which I'll tell you how to understand what would happen there. But you, on the long term, want to hold those shares. So you then, if you have the money, you have to have the money now. Remember this, you have to have the money. So if you have 5 contracts, you have the ability to buy 500 shares at $197.50, even though the share price is at $270. How long do you have to do that? Up until the expiration. So in this case, we're looking at June 22nd, 18. Up until June 22nd, 2018. To purchase. If we own the contracts, even though I never have exercised any options contract, for the record, just so you guys know, I have never done so. I buy and sell contracts. In other words, you see these bids and these asks, 143, 148, I treat these like stocks. I will buy for 143, sell for 47. I mean, and sometimes that's no exaggeration. I mean, as I'm sure you guys have seen in the recent postings I've been blowing up about Dropbox. But nevertheless, you have the right to exercise that contract. Everybody does, at any given time before expiration. So let's go back to here. All right. So let's say I am the, let me see what symbol we want to use. We'll use this one, and we'll put it here. Green. Let's say I own, let me think of a stock. Alright, let's say Dropbox. Let's just use that. Dropbox right now is, I think, roughly around $40 a share. Last I think it was $39. I'm going to go ahead and sell a call option for $60, right? I'm going to sell that call option $60 1 year out. As you can see, this is $365 1 year out. Now I'm going to sell that call option on the market for 60 cents, because we're just going to assume. Now don't quote me, we're just going to use 60 as a number just to use for an example, and I want to show you what happens to the price of the stock. I mean price of the options contract. Assuming that Dropbox doesn't change its price at all, it stays at $40 for the next year. All that would happen is this.